The debt bubble may be popping. After decades of debt accumulation, federal debt to GDP has exceeded 100% for the first time since World War II and continues to accelerate. And meanwhile, we see Fitch, a major credit rating agency, downgrade US credit from AAA to AA plus, as they see a combination of excessive government spending despite rising interest rates and rising inflationary pressures. At the same time, long-term government bond yields breaking out of the secular downtrend they've been in since 1980. Public debt to GDP projections suggest the ratio could reach 195% by 2050. They suggest that these risks, along with an erosion of fiscal government, as we have a debt ceiling crisis every time the debt ceiling is reached. So in this video, we'll be looking at whether we are on the brink of seeing a sovereign debt crisis, as we've seen US Treasury bonds break down and 30-year Treasury bond yields going parabolic since the announcement. And we'll also be looking at the unsustainability of the federal debt situation in the US, with interest payments on federal debt about to hit $1 trillion. And of course, the impact that all of this has on financial markets and what you can do about it as an investor. Now, without further ado, let's get right into it. Now, since the Fitch agency announcement, we've seen Treasury bond yields drop by around 4%. This is the ETF TLT that broke down below key support here at around $100. So the first big question following this announcement is, are we witnessing the beginning of a sovereign debt crisis? When you see headlines like the Fitch downgrade, it can cause bondholders to become skeptical of the US government's ability to pay back the debt. If you're right now holding US government debt and you're becoming doubtful of the US government's ability to pay back that debt that you own, you're going to be selling that debt. You're going to be selling those bonds. So that's what can happen during a sovereign debt crisis. Bondholders sell off their bonds. That causes government bond yields to spike, which actually puts the government in an even more difficult position to pay back its debt. This is something we saw in Greece in 2010 to 2012, where bond yields went from a reasonable 3.8% in 2010 and began to skyrocket as financial markets understood that the Greek government was unable to pay back its debt. So any rational investor that was holding Greek bonds was selling at that moment, causing unbelievably strong upwards pressure on long-term Greek bond yields. They went from around 4% back in 2010 to almost 40% at the height of the sovereign debt crisis, where of course the European Central Bank had to step in to bail out the Greek government. Now, let me reassure you straight away, if we look at 5-year CDS contracts that essentially show you how concerned the market is about the US government defaulting on its debt, we haven't seen any major change since the Fitch agency announcement. You can see CDS contracts spiked in April and May of 2023. That was actually during the debt ceiling crisis, where the government took too long to reach a deal on the debt ceiling. But since then, we've seen concerns around sovereign debt actually decline significantly and remain quite low. So by just looking at market data, it doesn't seem like investors are currently hedging against the possibility of a US debt default. And so it doesn't seem like the sell-off in Treasury bonds we've seen recently has actually got anything to do with the Fitch downgrade. Of course, that doesn't mean the fiscal situation in the US is squeaky clean. As I'm going to show you in a minute, the Fitch downgrade is potentially an early symptom of a much larger problem regarding the US fiscal situation, and there are major long-term risks associated with US sovereign debt, and how the US government is handling its deficit. We'll come back to that in just a second. But before we look at that, why are bonds actually falling here? Now, there's a couple of reasons why bonds have been under pressure. If we look at the 10-year yield against the economic surprise index, they tend to be very correlated. As you see the economic surprise index, so a strengthening economy, you tend to see government bond yields rise. And that's something that we've seen more recently as we've seen some strength in economic data. So that's one of the things that has been pushing yields higher. Of course, if we see economic weakness in the months ahead, as we head into a recession, you could see the very opposite phenomenon begin to happen, where you see economic data begin to surprise to the downside, and that's going to put downwards pressure on bond yields, and hence bond prices are going to be rising. The other key dynamic that's driving bond yields higher and bond prices lower today is actually in Japan. The Bank of Japan has made a tremendous shift in monetary policy, as the Bank of Japan has announced that they are going to tweak their yield curve controls, a monetary policy tool they've used to keep bond yields capped near 0%. You can see since the announcement right here, we've seen bond yields in Japan make multiple aggressive moves higher. Now, why do we actually care about that? Because Japan is the biggest holder of US Treasury bonds, owning about $1 trillion worth of government debt. One of the key reasons behind that is because the yield on Japanese bonds has been so low relative to the yield on US bonds. Since 2012, we've seen Japanese bonds yield less than 1% to any holder of that debt. So you can understand why Japan has been accumulating foreign debt, most notably US government debt. But of course, as Japanese bond yields rise, that story changes and it puts upwards pressure on US government bond yields as Japanese investors actually sell their US bonds to buy Japanese bonds instead. So you can see over the past few months, we've definitely seen Japanese and US government bond yields be very correlated to one another, and rising Japanese bond yields has put a lot of pressure on the US government bond market, causing US government bonds to sell off and US government bond yields to spike. Now, coming back to the long-term view of the fiscal situation in the US, we see government debt to GDP is projected to increase to 200% by 2050. To put this in perspective, the payment on the interest of government debt in 2050 is projected to be 3 times larger than the average spending we currently have on research and development, infrastructure, and education combined. So in other words, interest costs, just the money that the government needs to pay interest rates on its debt, will become an increasingly large part of the federal budget. And of course, that's without taking into account the possibility of government bond yields continuing to rise. Currently, bond yields are at 4%, but you can see from this chart they've broken out of a long-term downtrend because of recent inflationary pressures. If the government is unable to reduce fiscal expenditures and debt accumulation, it could cause inflationary pressures to mount and interest rates to continue rising, leading interest costs through the roof much faster than this chart predicts. And by the way, government spending has kept on rising throughout 2022 and 2023 despite strong inflationary pressures and rising interest rates. So what should investors do about this? One of the impacts of a lack of fiscal responsibility from the government can be seen by this ratio of gold against treasury bonds. So this is the relative performance of gold against TLT, the treasury bond ETF. You can see since March of 2020 here, we've seen gold outperform treasury bonds by 120%. In some way, this represents the falling confidence that investors have in government debt. Notice that gold, unlike treasury bonds, which are a debt asset, gold does not yield anything. The only reason that gold outperforms bonds is because of its scarcity. So in an environment where you have ever-expanding government debt, increasing fiscal spending, and high levels of inflation, which can lead to increasing inflation expectations, which can lead to further inflation, the scarcity that gold has to offer wins relative to debt-based assets like bonds. So one of the long-term impacts of a lack of fiscal responsibility from the US government is that gold continues to outperform treasury bonds as it has done so since 2003. Now, don't forget that fiscal spending is not the only thing that counts. monetary policy from the Federal Reserve also has tremendous impact on the economy. And unlike the government that's been spending throughout the last couple of years, we've seen the Fed do a lot of monetary tightening, and we are going to see that impact the financial markets over the next 6 months. You can see this recent data point on this survey that asks domestic banks whether they are tightening their lending standards for commercial and industrial loans. We have extremely tight credit conditions in the economy right now, and that has systematically anticipated recessions in the past, whether that's 2008, 2000, or 1990. And what typically happens to treasury bonds during recessions is that they actually outperform all other assets by a large margin, which could lead to a strong relative performance of bonds in the near term until the lack of fiscal responsibility once again becomes a major theme in the economy.